are going live. Testing, testing, testing. I'm going to give it just a moment, folks. All right. So, what is indexed universal life insurance? This has been asked to me so many times. It's time we address it. So, let me share a presentation so you guys can follow along. Okay, let's get it. So, um, let me get back to the beginning here. All right, life insurance spectrum. So we get asked this question all the time. In fact, I was just speaking with a business owner of a major publishing company and had never heard of an IUL or universal life in general. And so I am actually going to go through what life insurance is and how I see it in my brain. So I view insurance, life insurance especially, as a spectrum. Okay, so let's dive into that. So I don't think of it as a menu of things. I think of it as a spectrum. So if you said, on one end we have term life and on the other end we have whole, and then that spectrum is where universal life comes in. Okay. So it's clear to see them as points along a single line like this. All right. Now let's start with whole life. This is the OG of life insurance and it's guaranteed by design. So you just got a fixed premium, guaranteed cash value, guaranteed death benefit. You're going to have lifelong coverage. So that's built to last your entire life, not a set number of years, as opposed to the other end of the spectrum with term. And even whole life, it builds cash value, which is the equivalent of equity in property. So if you had a house and you had equity in your home, the cash value bucket in whole life would be your access to that money. You could actually pull that money out. Okay. But so the cash value grows on a guaranteed schedule that you can count on. Let's say that's like 3%. Okay. So it's a guaranteed 3% return. But what most people don't know is that cash value can come out and use that in retirement. You can use it before retirement. Just like a Roth IRA, the money would come out with no taxes due. So I like to call that tax privileged. Okay. And so the trade off here with whole life is it's the most expensive option and the least flexible, but you're buying certainty. And so a lot of people that are leaning more toward guarantees and certainty, and all of them have guarantees, but this one is more fixed, more rigid, and a lot of people like that structure because it's certain and it's the OG. And so people trust it more naturally. Now, term life. Everybody has heard Dave Ramsey at some point. If you have not, you will. Dave Ramsey says all the time, buy term, invest the rest. Buy term and invest the rest. Well, that's great, especially if you're following his exact protocol of exactly what you're trying to achieve in his programs. Now, let's just break down what term is. So it's on the right end of the spectrum here as we portrayed it earlier. And it's just purely stripped down protection, nothing fancy here. It's the lowest cost, cheapest way to get a larger death benefit. All right. And so term's really neat. In fact, it's what I started with. Currently, I have a 30-year, $2 million term life insurance policy. So it is temporary by design. It covers a set window, typically 10, 20, or 30 years. There is no cash value accumulation whatsoever, but it is the right tool for a lot of people. For a lot of families, simple protection is exactly what they want, and that's enough for them. A really neat feature to bring about with term is not all of them, but quite a few of them have living benefits, and a lot of them now have what's called a conversion characteristic, if you will. It just allows you to convert portions or all of your term life into permanent policies later down the road. And so for a lot of people, this is a smart move because maybe you don't have the budget to commit to one of these other more permanent types of policies. And what term would do is it would preserve your insurability. So if you're the healthiest you're ever going to be right now, in theory, you would go ahead and purchase as much term life as you could with the ability to convert it later on, regardless of your health condition. So if your health did degrade later on, you'd be able to convert this with guaranteed insurability later on. So it'd be based on your new age and your original health diagnosis. So if you got a super preferred rate, and you think you might not get that later on, you would be able to hear. Thank you, Grayson. My son's artwork. So term life insurance is a really great way to make sure that you get in really, really cheap and that you can preserve insurability if that's something that you're wanting to keep in mind. But just know that it will terminate later. So sometimes it's better to play the long game, but it's just contextual to you. Now, to explain the question of the day, universal life. I want you to think of this spectrum that you can see on the screen here. Universal life is flexible and can be customized to lean one direction or the other. And so whole life, we just discussed that. It's good for your whole life. It's the most rigid product. Term, it's going to expire. All right. Now, that's great. Now, what universal life comes in and does, and you need to make sure the broker knows what they're doing because they can really mess you up doing this. It's a more complex product, but it's flexible, permanent coverage. You can adjust the premium. You can adjust the death benefit. You can customize it literally to be more like term or more like whole life. And so universal life is a great way to position people depending on the scenario, because not everybody's going to just buy a whole life and not everybody's just going to buy a term. Sometimes it's a combination of all three, or sometimes it's a universal life designed to be more like one thing or the other. And so let me explain the index part. So I'll just explain universal life. It can be customized to look like one or the other here, or a combination, just however far each direction on the spectrum you want to be. Now, where index comes in IUL, indexed universal life, with indexed universal life, cash value growth is tied to a market index like the S&P 500. So indexed literally means that the growth of the cash value in the policy is tied to an index. It's not in the market. The money is not in the market. This is an insurance product. It cannot be. But the insurer credits interest based on how that index performs inside whatever their set guardrails are, and I'm about to explain those guardrails. But so if the S&P 500 is doing this, then the index that you're tied to, it's going to dictate how you grow, but it's not actually in the market. They're just using the market to determine how much growth they're going to pay you out on the cash value. So 3 guardrails that we're talking about here, okay? So now, here's the deal with the index portion. You're giving up some of the highs in exchange for never taking the lows. All right, so there's a floor. That's your first guardrail. The floor is usually 0%. So a down market doesn't shrink your index cash value. 0 returns on the cash value is the worst case scenario. That's awesome. You can't lose money. Great. Sequence of returns here is not an issue because you can't lose money. That's awesome. My investors and people that are more savvy know what I mean by sequence of returns risk, and that eliminates that. Now, there's pros and cons to everything, but that's just one thing that it eliminates. And then another guardrail here is your cap, often 9 to 12%, but your upside is limited, right? So if the cap is 10% and your S&P 500 index gained 12, you're going to only be credited 10%. But the trade-out is that you can't lose. It's a pretty good trade, depending on what your cap rates are. And then there's participation rates, which is another strategy tied to the index. It's often 50 to 100% on the S&P. So the share of the index's gain that you receive, maybe you're at 70%. And so a 10% gain would credit you 7%. And so the cap is a strategy and the participation is a type of strategy. All right. And so that strategy is what lets you make money and is what lets the insurance carrier make money, because everybody needs to make money for everybody to win. That's just how it works. All right. So the 3 guardrails are floor, cap, and participation. So you can make money, but you can never lose. The only thing that costs you money in an insurance policy are the fees, and they're built into the premium. But that's just the same thing as a mortgage. And something else to bring about that I didn't mention, and I don't think I mentioned here in just a minute, is just like your 30-year mortgage, all of your fees and all of those things are front end loaded on the first 10 years of your mortgage. It is the same case with your life insurance. And so in one of our other talks, our retirement wealth blueprint, we discussed that a little bit more in detail. But just so you know, you don't start seeing the compounding effect of all of this until after year 10, typically. Not always true. You can do a massive down payment into this up front, just like if you're putting a down payment on a house. And a good portion of that immediately goes into the cash value, which allows the compounding effect to happen a lot faster because you're throwing momentum in on the front end using a down payment. Okay. So Index Universal Life has a few guardrails. And so let me dive into this real quick a bit more. So same policy, two different bills, right? So if you lean left toward whole life, you fund it generously. So we're saying if you're building an IUL to look a little bit more like whole life, you want to do a max fund. And what that means is in the IRS tax code 1035, it talks about a lot of things, but in some other instances, you run into some language called a MEC, a modified endowment contract. And a modified endowment contract just means that if you spend more than what the government allows you to spend based on your premium, which you can do a max premium. If you pay more than the max, you will turn your life insurance contract into a modified endowment contract, and that takes away the tax privileges that life insurance would have. And so the only tax privilege asset you would have if it turned into a MEC, a modified endowment contract, would be your cash value. And so there are instances where that does make sense to do that, but it wouldn't function as a typical death benefit any longer. Okay. There would be taxes owed on the money when you die. All right. Now, fund it generously. You want to hit the max fund. Okay. You get a smaller death benefit when you're leaning left toward the whole life here, but that smaller death benefit versus the premium, that's going to give you more going into your cash value bucket. And so the focus when you're leaning more toward whole life here would be more of a tax advantage cash value play. And so the cash value is going to grow, let's just say on average 4 to 6%, a little bit better than whole life. And it can do better than that. All right. I've seen some do north of 8%, but typically you're looking at 4% or better. Okay. And so it's tax advantaged cash value growth, because when you pull the cash value out, it's a policy loan. You're borrowing it out. But what a lot of people don't understand is when you borrow money from your cash value, there's no credit score check, there's no credit score reporting, and you don't have to pay it back immediately. And because it's a loan, it's tax-free when it comes to you. And now your death benefit will pay this back so long as you keep making your premium payments. And if you wanted to pay it back, you can. It just has it where it's pretty flexible. And in some of our other talks, we give you case studies like the story of Walt Disney and how he used life insurance to fund Disney as we know it today. And so there's a lot of really neat stories that kind of illustrate this. But just know that when you lean more toward whole life, you're looking at a cash value play. And that's a specific strategy for the right person, but it still has a death benefit and it's still life insurance. You need to understand that it's still an insurance policy. Now, if we wanted to look a little bit more like term, this is typically when we're doing some estate planning, and the policy maybe is going to be used to build up the estate of a trust. Maybe it's an irrevocable family trust, and you're going to pay less money per month than you would if you lean more toward the left here. But since you're leaning more right, which is toward term in this illustration, you would do not always a minimum funded, but you would push the death benefit as high as possible. And your focus here would be flexible permanent protection. And so you're not looking for cash value in this particular instance when it's looking more like term. You're looking for a higher death benefit guaranteed to a certain age. All right. And that's what builds the estate up. Okay. So in a lot of cases, as an example, let's say we're doing estate planning with you. And where would this come into play? This last one that I illustrated. Well, if you want your cake and you want to have your icing and eat it too, you want the whole nine, then let's say you created some guaranteed income and you've got more than you need to live on. And so we use your current existing assets to pay for the insurance instead of you having to take it out of your current living budget. Okay, so it wouldn't affect your budget in that scenario. And so what we do in a lot of cases is the owner of the policy would be your trust, and then the beneficiary would be the trust, but the insured on the policy would be you. And so if you had like a 401k or an IRA where the money was earmarked to your social security number, you can't move that money into a trust because a trust is made up of a EIN number. It's made out of an LLC, similar to a business. And so the way you kind of quote unquote wash the money of taxes is you meet the smallest tax requirement possible through controlled distribution from that asset. And then that distribution pays your life insurance premiums. That's essentially how it works. A little bit oversimplified, but that's how it works. All right, so you can design universal life, specifically index universal life, to look just like this right here, okay? You can have it looking more like term or looking more like whole life, and it works really, really well in different circumstances. I really like an IUL a lot, depending on how you design it. Now, who index universal life tends to fit? It's somebody that wants permanent coverage, they value flexibility, they want some growth potential, and maybe they've maxed out some of their other buckets. And what I mean by buckets, we teach this in one of our talks that we give, and we call it qualified, non-qualified, and privileged. Right now, we're talking about privileged buckets, and by buckets, we're referring to tax status. And so, qualified money is like 401ks, IRA. It qualifies for tax deferred status, meaning the government has a guaranteed lien on your money, and when you turn 73 due to required minimum distributions, they make you start paying taxes then. And so one way to mitigate how much the percentage is year over year is that you spread how much your RMDs are or any other taxes that you might owe over a longer time horizon, and it shrinks the marginal tax rate for you. Now, I'm not a tax professional. We would coordinate with your CPA to do that, or you would coordinate with your CPA to do that, to calculate your tax rate and such. But essentially, the theory here is that you would use this sometimes in that scenario, in that estate planning scenario, to do that. But it allows you to have value flexibility. So that means the premiums and death benefit can be adjusted as your life changes. You want some growth potential. And so the cash value thing that we mentioned, the upside is tied to an index like the S&P 500 with a floor under the downside, so you can't lose. And then maybe you've maxed out your Roth IRA, or maybe you're a high income earner and you can't do a Roth IRA. This is a way to initiate what a lot of people would refer to as a Roth IRA alternative. This is an alternative type of asset. I wouldn't call this an investment, although it functions in a similar capacity, but it's still defined as insurance. Okay. Now, here's some honest caveats that we need to bring up. Universal life is way more complex than, a term policy. There's just more layers to it. And so sometimes people can have a little reservation because of complexity. But what we do here really well is that we simplify things into a manner that anybody can understand. So if you're interested, or you've read or heard, or whatever curiosity you have about an IUL, just give us a shout. You can comment here. You can give us a call at 662-200-2249. But an IUL can be more complex, and it can be more expensive than term life insurance. All right. It depends on what you're solving for. But typically term is always going to be cheaper. So if you're buying on payment, yeah, a lot of times term is going to be more appealing. I cannot tell you how many scenarios people call us asking about whole life or universal life. And then they end up going to somebody else for term life. And we never got to even educate them. They just start shopping. And so the problem with consumers, and I'm a consumer in my own capacity as well, is that we need to find people that can educate us a smidge, because when you're talking about insurance, it's not like buying something on Amazon. This is a policy that covers you. All right, this is a big deal. So how we go about this is important. So it is more complex, it is more expensive to term, and it uses projections to help you see what it would look like, not guarantees. And that's with anything. No one can predict the future. We can only take past assumptions or data and use that to illustrate what we believe it's going to look like going forward. It's not a guarantee, it's a projection. And so anyone that sells you this as a guarantee is completely wrong, and they shouldn't be saying it that way anyway. You should use that as a signal to run. But it's a projection. So when you get an illustration from an agent, it's a projection, not a guarantee. What are you getting? Oh, you're getting a color? Okay. That's my son, Grayson. But caps can change. So caps, remember, that was how your money grows. So insurance companies reserve the right to lower or adjust their caps and participation rates. Now, it doesn't always lower. Sometimes they go up. We've had several companies over the last few months raise their participation and cap rates. And so that means our clients are experiencing better gains because of that. It's really, really neat. There's just a lot of layers to this, but like, where do you belong on the spectrum of life insurance? And so the answer is there's no single best product. It's only the right fit for your budget, timeline, and what you're protecting or building. because sometimes it's not about just protection, it's about building something. And so for me, my term life insurance, I told you earlier, I personally have a uh, uh, $2 million 30-year term life insurance policy with living benefits. And the reason that I have that is because I am building something. I have key man risk on me, and I want to make sure that everything is fine if something happens to me. And so, even in business succession, even in business partnerships, this is very common with lawyers. They'll take out policies for key man risk because if you have a partner who your business is depending on, it's going to be expensive to replace somebody like that. So that's a reason to have a policy from a business standpoint. But where do you belong on the spectrum? Well, that's what the conversations are for. So you figure it out with the right broker. Hopefully that's us. We would love to work with you. Love to help you with that. Some other things here that I wanted to show you. Let me go back to one more thing here, and then we'll wrap up with this. So when you're looking at life insurance as a spectrum, there we go. I just want you to see it visually, okay? It's on a spectrum. And then to summarize this, to oversimplify this, you have whole life and you have term life. Whole life is good permanently. The premium that you pay is permanent. The death benefit that you get is permanent. It's very rigid. Term life has a set payment, can sometimes have living benefits, and can be converted, not always, but in a lot of cases, to a permanent life policy. Now, term has less expense per dollar of coverage, which is why oftentimes you see people purchase that, especially when they're younger. The downside, though, is that you need life insurance well past, you turning 65 years old. Okay, especially if legacy is something that you're wanting to do. And so in a lot of cases, when we're helping people transition to retirement, we bring up a lot of scenarios. And one of the things that we discuss is, who are your beneficiaries? And do you want them to have anything? Because not everybody wants to leave anything. Every culture is different, and so we work with all types of people. But if it's you wanting to leave something to your family, you probably need universal or a permanent type of life insurance. If you're just covering risk and debt and things like that, maybe it's term life. And term life is often given concept names, and we're going to wrap with this. Some concepts for term could be mortgage protection. It could be key man. It could be a lot of different things. Like for whole life, you might hear final expense or burial, or you might even hear key man for that. People use concepts to bring about products because the concepts explain the gap or the problem that you're solving, whereas a product just feels like a product. And so where these products may come into play, I mentioned earlier, but just to recap and get off of here, is you have just death benefit. You just want to make sure your burial's covered. That's also known as final expenses. Maybe you want to use it for your kids' college education or to fund their business. And so you would want something that creates cash value. Good job, bud. Cash value for somebody like that. And that cash value your kid could borrow from and not have to pay it back immediately. And that's a great way for them to start their business. Especially if they don't have any credit built, the cash value allows you to borrow money from that account, and you can almost pay it back on your terms. And in a lot of cases, that policy loan interest rate is a net zero interest. In a lot of cases, it never goes over 5%. Okay. I believe Walt Disney back in 1955, I believe his interest rate on his policy would have been somewhere around 2 or 3%. So, very, very favorable terms when you borrow money from a policy like this. And a lot of the carriers that we're using or predominantly using for most scenarios usually have a net zero loan cost. Okay. So I hope this has answered everyone's question today. I've been asked several times, our team has been asked several times, what's an IUL? What's universal? So Universal Life is the newest life insurance product on the block. It's been around for several years now, but if it's not designed correctly, it's almost worthless because it'll lapse or it'll eat itself alive. Back in the day, brokers would sell people on the most minimum premium, but like my own grandparent, or one of them, had a universal life, and it lapsed, and she could have actually used a death benefit. But I didn't design that. I just interpreted it for her. I was the bearer of bad news. So you got three major products, right? and they all fit on that spectrum. On one end, you have whole life. On the other end, you have term. And universal can be customized to take on different characteristics, so it kind of floats on the spectrum there. Okay. Well, again, my name's Justin Stark, and I'm with Pontotoc Insurance Agency. Today, I hope you have been educated a bit on an IUL. All right. Till next time. See you soon.